All right, so now we're going to talk about special merchandising transactions. These are things that happen only for merchandising businesses and how we would journalize these things. So before we get into this, I want to let you know that there's actually two parts to this that we're going to look at, because remember, we are the business. And as the merchandising business, we kind of have two sides to it. We have it where we are the purchaser, and there's certain events that happen with that. And then there's times when we're the seller, and there's certain events that deal with that. So in this one, we're dealing specifically with transactions from purchasing. So we're the ones that's buying it. We're the buyer. Okay. So let's start with the first one. The first one's going to be purchase returns and sales. So we purchase something, we purchase some inventory, something goes wrong, and we need to return it. Okay. So again, a return is merchandise a buyer purchases and takes back. I buy it, I take it back because something didn't work, or I don't like it, or it's broke. Okay. The effects of the return is the opposite of the original. That's the key. Okay. It is the opposite of the original. So if we purchase it one way and we put it in our books and as a journal entry one way, then if we return it, then naturally it's just going to be the opposite of. The debit becomes a credit and the credit becomes a debit. Okay. So let's look at this. This is the original one. Merchandise inventory is debited, meaning our inventory goes down, goes up, and our cash goes down because it's credited. Okay. That's us bringing it in. So what would the journal entry look like if we returned it? Well, if we returned it, it would just be flipped. It would be cash and AP is going to be the debit, and then merchandise inventory is going to be the credit. We just do the exact opposite. That's the easiest one of them all. Just remember it's the opposite of the original. Okay. Another thing, well, let me speak a little bit about allowances. Allowances are a little different. Allowances are, I'm not returning the inventory per se, the physical inventory, but I call the company and say, hey, I don't want this inventory anymore. I want to return it. And maybe they'll say, you know what? You keep the inventory. We'll just discount your price. We'll just take it off of what you owe us. So instead of purchasing a table that costs $100 and there's something wrong with it and you want to take it back, they say, you know what? You keep it. You keep the table and we're only going to charge you $50 for it. Okay? That's what an allowance is. Now, the journal entry would still be the same. It's not going to change because we don't care about the physical inventory. We care about the value of the inventory. So we're still losing the value of the inventory and we're getting it off of our accounts payable or our cash. The next one we're going to talk about, or actually I think this is the next one, is the allowance. It is. An allowance is a reduction in the cost of defective or unaccepted merchandise that a buyer acquires. Again, it's going to be the exact same thing. It's going to be cash and AP. And then merchandise inventory is going to be the credit. So it still follows the opposite of the original for this. I just jumped the gun a little bit on that one. The next one that we're going to talk about is purchase discounts. Okay, and a purchase discount is a cash discount applied to a purchase. Now there's a couple things here that I want to make sure you understand. There's different types of discounts. You have what's called a customer discount, you have what's called a trade discount, and then you have what's called a cash discount. A trade discount is pretty much what we're the most familiar with. You walk into a store, you don't look for anything that doesn't have a sign that says 50% off. That is a customer discount. And that what they're doing is they're incentivizing you just to buy. Okay? If you buy it, you get 50% off. And that's taken off, that 50% off is taken off at the time of purchase, so you're not really going to see it in the journal entries. A trade discount is a little bit different. Maybe you have some experience with this. And these are the ones where if you purchase 0 to 10 of something, it's going to be 99 cents per item. But if you purchase 11 to 20, it's going to be 90 cents per item. If you purchase 21 to 30, it's going to be 85 cents per item. And what they're incentivizing you to do is to purchase more. The more you purchase, the less it is per unit. And so that's a trade discount. This is a cash discount. And what this one is incentivizing the customers to do is to pay earlier. This one only happens when you're paying on account. When you're using your AP or your AR. In this situation, you're dealing with AP because we're the buyer. So in this one, I'm incentivizing, or I'm getting incentivized to pay off my bill earlier. And this looks a very specific way. This looks just like this. 2/10, N/30. The numbers can be any number out there. It's just depending on what the company chooses. But the position of those numbers are very important. Okay, and so that's what I'm going to talk about right now. By the way, this is read 210 net 30 if it's these numbers. It could be 315 net 45 or 15 net whatever. And you could also see net EOM, which means end of month. It has to be paid off by the end of the month. But let's talk about these. So the number in the first position, where the 2 is in this one, okay, like I said, it could be anything, but where the 2 is in this one, that first position, that is the discounted percentage. So if this was given to me as a purchase discount, then what they're saying is they'll give me a 2% discount. Very gracious. Okay, 2%. However, the second number where the 10 is, that position is the discounted period. So what this is saying is they're going to offer me a 2% discount if I pay within the first 10 days on whatever I pay in the first 10 days. The N, which is always going to be the N, that's net. That's the total. The last one is when it has to be paid off in total. That's the payment due date. So what we're saying is whatever you pay for in the first 10 days, they're going to give you a 2% discount. But the whole bill, the whole balance has to be paid off in 30 days. So if it's $315 net 35, then you get a 3% discount in the first 15 days, but the entire thing has to be paid for in 45 days. That's what that means. Okay. So let's look how this would work in terms of your journal entry. Okay. By the way, this for the payable amounts paid within the discounted period, the inventory account is decreased by the discount amount. And you'll see that work here in a minute. So this is what it would look like. If I was paying this off within the 10 days and I got the 2% discount, the first things first is I'm going to take care of my accounts payable. And I'm going to debit the entire amount of the accounts payable. So if it was a $10,000 accounts payable, I'm paying off the entire $10,000 amount, okay, the payable amount. The second part, I'm going to start going to my credits. And the credit is going to be cash first. And that's going to be the payable amount minus the discount because, yes, I'm paying the full $10,000 off, but I'm not paying $10,000 cash. I'm paying whatever it is minus the discount because that's what I'm paying for within those days. And then finally, that difference, because remember, our debits and our credits have to equal. So right now they're not because the accounts payable is a certain amount and the cash is that amount minus the discount. The third thing that I have to do is I'm going to have to credit inventory because I'm lowering the value of my inventory by whatever that discounted amount is. That's how we deal with purchase discounts. You're going to see this a lot better actually in use when you watch the example video that's, I think, after this or at the end of this chapter. So that's how we deal with purchase discounts. The last thing we're going to talk about from the purchase side of it is going to be transportation. Transportation costs. Now, transportation costs comes in two ways. It comes in two manners. So the responsible party or the paying party, if you're the responsible party, you're the one paying, of the freight cost depends on which party assumes the risk of the loss during the transit. I know that's the legality side of it, okay? From the buyer's side of it, if the risk is of loss during transit is assumed by the buyer, meaning it begins at the point of shipment. So if you're the buyer, you assume the risk of loss all the way through the transportation up to the point that gets to you, and then you get it there as well. Then that's called FOB shipping point. FOB is free on board. And shipping point lets you know that it starts at the point of shipment and you keep that same liability all the way through to your business. So if you look at it this way, you have the seller, the transportation, and the buyer. And you have the shipping point and destination, and it starts at the shipping point, goes to the destination. If it's FOB shipping point, your liability starts at the beginning of transportation all the way through the destination. So you obtain that risk from the very beginning. Okay, that is how you deal with FOB shipping point. I'll give you the counter to that in the next video when we talk about the sales side of it. But let's talk about how we would journalize this. If this were to happen for us, what we would do is we would take that cost of shipment and put it into our inventory. We would actually put it into inventory because that is part of the cost of the inventory to get it to our facility and ready for its intended purpose, which is to sell. And so that's why we would add it to inventory. I know it's not transportation cost, it's not physical inventory, but that is also the cost of the inventory to get it to us, not only the invoice cost of the inventory. Okay, and then also we would also credit cash because that's what we have to pay. That is how we do the special inventory journal entries specific to purchases. Again, in the next video, we'll be talking about it specific to the seller. So, appreciate it.